Founder of Uplinq, to discuss what could have potentially helped to prevent Silicon Valley Bank's collapse. Patrick, it's great to see you as always. Welcome back to Trade Talks.
Yeah, it's great to be back. Always good to be speaking with you.
You got it. I mean, since we saw each other in Vegas at CES, a lot has happened. Silicon Valley Bank and a number of other major financial institutions have collapsed, which we continue to grapple with. What does the future hold for the US financial system?
Well, I think first of all, what people should know is overall, I think the banking system is in really good shape. However, there are a lot of banks who are guilty of complacency. I think, after years of ultra low funding costs and, rapidly increasing property values, it became almost impossible for banks to lose money with real estate loan portfolios. But, there's a concept that if you're making 30-year loans, you can't expect the economy to remain the same. And I think a lot of folks sort of fell into that trap. And I think it's time to wake up from the fantasy that, perpetually increasing property values are going to happen, that we're going to continue to have rounding error interest rates. They may return at some point in time, but they're not here today. So this, in short, is a problem really caused by there are two really main principles in banking, and that is you have to manage interest rate risk and you have to manage concentration risk, which means you don't put all your eggs in one basket, you spread them out. And your Nasdaq audience understands well the values of portfolio diversification. In this case, banks fundamentally dropped the ball in this category. And so now we end up with a disruption. For most banks, the portfolio concentrations aren't so extreme in these places. They're not manageable. But for some, and some of the ones we've seen, it's been a complete game changer.
What are some of the ripple effects of SVB's collapse on small business lending? Are banks less likely to grant loans now?
It's really interesting. I think almost the opposite has happened. I think people have looked at their own concentration risks as real estate portfolios have grown within bank books. It's important for your audience to understand about 44% of the US economy is driven off of small business. About 3% of bank balance sheets are made up of small business loans. And so many lenders are looking at it as a growth horizon and an opportunity to, in fact, diversify. These tend to be shorter term loans. They tend to have loans with larger spreads. And so by their very nature, they're somewhat more insulated from some of the problems that we are seeing right now. So Uplinq is actually getting flooded with a lot of interest and a lot of requests for help us underwrite better in these categories, help us reach underserved segments within the marketplace, thinking about things like rural markets and underserved categories like minority groups, women business owners. How do we really do a great job there? By the way, that dovetails into Dodd-Frank CFPB 1071, which is now an increased focus. It says, we want to treat small business owners just like we treat individual consumers in terms of the rules of fairness, and we want to make sure that credit is available to everyone. So this is really creating a lot of interest. It's an exciting time. I really hope it's successful. It'll help grow the overall economy. We'll all win in the process.
Some are calling for increased federal regulation and oversight over the financial sector after the recent volatility that we saw with the banks. Do you believe this is the right approach?
I really don't think we need additional regulation. I can appreciate from the outside looking in, people may look and say, well, gee, there are these, we have these problems, we need to get a fix. And in this particular case, both interest rate risk management, concentration risk management have been principles in the regulations for many, many years. What we have here is a failure of both bankers and regulators to police those rules and really use best practice to an outcome. So if anything, we should be very frustrated that, in the banking industry, as an example, if you sail a ship into the rocks, if you have a failed bank, you don't get to work in banking again. I'd like to see the same thing in this case applied to regulators. Fundamentally, they dropped the ball. They weren't holding people like SVB to the same standard. They hold a lot of institutions. And in this case, we all paid a price for it, right? In other words, when we think about FDIC doing a bailout, that FDIC insurance kitty is made up of money that you and I otherwise could have. And so when we see these kind of gaps, we really need better oversight. We don't need additional regulation. We have people who just simply didn't do what they should have done.
What's an important distinction to make from your standpoint? What could have helped to prevent SVB's collapse? Was it in fact avoidable?
You know what? It genuinely was 100% avoidable. It was run as a good old boys club, to be really honest with you. Both the depositors and the lenders were relatively tight knit group. We didn't have good diversification. We had a lot of these failures that we've talked about, and so if simple, fundamental, good banking practice would have been applied, this error could have been avoided. The public's paid dearly for it, right? And so so now it's a time to really say good banking regulation, good banking policy should apply to everyone, every state, every market. Consumers need to have confidence that their deposits are secured. I think the government has stepped in and tried to address that a little bit, at least after the horses left the barn. But I think good regulation and good policing of these fundamental practices is the real cure.
What do the recently increased interest rates mean for the future of banking? Do you expect another hike soon?
Oh boy, I wish the answer to that was no, but I think the answer is yes. I mean, it's honestly, the best way to get a handle on inflation is to minimize deficit spending. And I 100% understand that this is not a popular thing to do for, legislators that are trying to capture votes and, people trying to offer more free candy from the candy bowl. But the reality is that trying to do this through interest rates, we all have to be really, really mindful of the impact that it has on investment, right? You increase in interest rates, you're going to decrease investments. And most importantly, and something we've seen really interesting, I looked at an Equifax study just yesterday that looked at a broad view of the types of people who are now no longer able to get credit. It shouldn't come as a surprise to anybody that the people hardest hit by this are the people who've historically been most marginalized. And so higher risk, near prime, subprime credit seekers now no longer can get it. How big is the problem? Just to give you a feel for how big it is, since 2020, 75% of the subprime real estate market for consumers has gone away. That's huge. You think about it, a lot of people are just fundamentally priced out of the marketplace now. Payments are too high, they can't make it, and now that's gone. We really need to think more keenly about how we drive value to people rather than just trying to come up with a nice big candy bowl. What we really need to do is think about driving value to everybody.
Yeah. All right, Pat. Any other parting thoughts for us?
Hey, wow, keep an eye on commercial real estate, right? What we have right now, I mean, if you want to think about the next thing that's going to happen, not the SVB thing, there's been just fundamental changes in commercial property. And so look at those bank books. If you're an investor and you're thinking about what to do, I would put a keen eye on that. And as always, thanks for having me.
All right, you got it. Great to catch up with you as always, Pat. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Take it. Bye-bye.